Financial crises rarely begin with panic.
They usually begin quietly during periods of optimism.
Credit expands rapidly across the financial system.
Easy borrowing fuels rising asset prices.
And leverage begins to build beneath the surface.
Housing credit expands quickly across the country.
Banks compete aggressively to issue more loans.
Households take on more debt than before.
Rising prices reinforce the belief that risk is low.
But beneath the optimism, vulnerabilities begin to grow.
Financial innovation begins to spread risk across markets.
Loans are bundled and sold as complex securities. Investors around the world buy these instruments.
Risk models appear stable during calm markets.
But hidden risks quietly accumulate across the system.
Home prices continue rising across the United States.
Lending standards begin to weaken.
More loans are issued to increasingly risky borrowers.
Asset prices appear to justify the growing debt.
But the system is becoming dangerously fragile.
Mortgages are packaged into complex financial securities. Indulgence.
Investors worldwide purchase these structured products.
Financial institutions increasingly rely on leverage.
Risk appears manageable during stable markets.
Risk appears manageable during stable markets.
Eventually, housing prices stop rising.
Demand for new homes begins to weaken.
Some borrowers start missing their payments.
Mortgage securities begin losing value.
And confidence across the system begins to weaken.
Mortgage defaults begin rising across the country.
Mortgage-backed securities start losing credibility.
Banks begin recognizing losses on their balance sheets.
Financial institutions grow cautious about lending to each other. Liquidity in funding markets begins to tighten.
Funding markets begin showing signs of stress.
Banks grow uncertain about each other's stability.
Prices of structured credit products continue falling.
Volatility spreads through financial markets.
The financial system becomes increasingly fragile.
Major financial institutions begin facing severe pressure.
Confidence suddenly collapses across the markets.
A major investment bank fails.
Credit markets begin to freeze. The financial crisis becomes visible to the world.
Investors rush to sell risky assets.
Institutions struggle to obtain funding.
Assets are sold rapidly to raise cash.
Losses spread across the financial system.
A localized problem becomes a systemic crisis.
Major banks face severe solvency concerns. Government officials begin emergency meetings.
Losses spread across the financial system.
Authorities introduce large financial rescue programs.
Gradually, confidence begins to stabilize. The crisis spreads into the real economy. Housing markets experience widespread foreclosures.
Regulators begin reviewing the causes of the crisis.
New rules aim to strengthen the financial system.
Financial markets slowly begin to recover.
Banks are required to hold stronger capital buffers.
Regulators increase oversight of systemic risk.
Early warning indicators receive greater attention.
Economists study how crises actually begin.
Financial systems remain complex and interconnected. Credit cycles continue shaping financial markets. Periods of optimism can return surprisingly quickly.
Risk can quietly build beneath strong markets.
Understanding these patterns helps reveal future crises.
Financial crises have repeated throughout modern history.
Each crisis reveals weaknesses in the financial system.
But the cycle of risk and optimism never fully disappears.
The early stages of crises are often invisible.
Banks began reporting losses on mortgage assets. Mortgage securities lost credibility among investors. Financial institutions